Good evening, everyone. Welcome to the channel. Today I am going to talk about Cspc Pharma interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. The Cspc Pharmaceutical Group Limited offers a wide range of pharmaceutical products and services across various segments. The company provides medications for conditions such as stroke, cancer, diabetes, osteoporosis, arthritis, and pain management. Their product portfolio includes soft capsules, injections, and functional food products. Some notable products include NBP and Ulaning for neurological disorders, Duomisu for cancer treatment, Jiniuli to prevent chemotherapy-induced side effects, Kiali for breast cancer, Shuluok, Nuamoling, Waihang, and Xinweihang for infections, Xuaning for hypertension, and Kun to prevent atherosclerotic thrombosis events. In addition to these products, the company also offers antibiotics, vitamin C, and caffeine APIs, functional food products, healthcare services, a strategic collaboration with AstraZeneca plc to advance novel oral candidates. The stock price of Cspc Pharmaceutical Group has skyrocketed in the past year due to several strategic shifts and developments. The company's major licensing deals, including a potential $5 billion deal with AstraZeneca, have significantly contributed to its growth. Additionally, partnerships with BeiGene and Radiance Biopharma have secured substantial upfront payments and milestone fees. Cspc Pharma's robust pipeline of new drug candidates, including 6 in phase III trials, has also boosted investor confidence. Furthermore, the company's share buyback programs and positive analyst sentiment have further driven up its stock price. Overall, Cspc Pharmaceutical Group's innovative approach to drug development and strategic partnerships have been key drivers of its remarkable growth over the past year. The primary drivers of revenue growth and decline can be summarized as follows. Revenue growth drivers: 1. Strong sales growth in bulk products, plus 11.9%, and functional food and others, plus 8%. 2. Innovative R&D achievements, commercialization of core products, and out-licensing of innovative products. 3. Strategic partnerships such as the collaboration with AstraZeneca and a robust pipeline of new products. 4. International expansion to tap into global markets and increase revenue. Revenue decline drivers: 1. Significant decline in finished drugs, minus 24.4%, primarily due to price adjustments for core products. 2. Decrease in revenue from centralized volume-based procurement policies affecting public medical institutions. 3. Market demand shifts, leading to declines in sales of certain products, such as Encun and Abicang. These drivers highlight the key factors contributing to both growth and decline in revenue, providing insights into areas that require attention for future improvement. Net income and profit margins. A decline in performance. The financial performance of the company has witnessed a decline in net income and profit margins. Net income decreased by 18.5% to RMB 13,273 million, indicating a significant drop in earnings. The gross profit margin also declined by 6 percentage points to 65.6%, further highlighting the decrease in profitability. The decrease in net income can be attributed to various factors, including unquoted investments, which decreased due to estimated discount rates and long-term pre-tax operating margins. On the other hand, structured bank deposits showed an increase due to expected yields of underlying investments. Overall, these changes indicate a decline in the company's financial performance, necessitating a review of its business strategies to improve profitability. The company is indeed generating positive operating cash flow, as evident from the significant increase in net cash from operating activities. In the first half of 2025, the company recorded a substantial inflow of RMB 3,187 million, compared to RMB 425,425 in 2024. This indicates a notable improvement in the company's ability to generate cash from its core operations, suggesting a healthy financial position. The company's debt level and interest expenses have undergone significant changes. Notably, the debt level has decreased substantially from RMB 392 million as of December 31, 2024 to RMB 247 million as of December 31, 2025. This reduction is attributed to a decrease in bank borrowings by RMB 143,745. However, interest expenses have shown mixed results. While interest on lease liabilities decreased by 8%, interest on bank borrowings increased by RMB 631. The introduction of this new expense suggests that the company's financial obligations may be shifting towards more costly forms of borrowing. The company's financial performance varied across segments and regions. In terms of finished drugs, the segment saw a decline of -24.4%, with a significant decrease in profit from RMB 3,488,515 to RMB 2,392,744. On the other hand, bulk products showed growth of +11.9%, but still experienced a decrease in profit. Functional food and others also grew by +8%. However, vitamin C performed poorly with a decline of -21.7%, while antibiotics saw an increase of +19.6%. Geographically, mainland China's performance was poor, with revenue decreasing from $14,256,973 to $10,553,392, and its share of total revenue declining from 88% to 64%. In contrast, other Asian regions, Europe and North America showed good performance, with increases in revenue and shares of total revenue. Management is optimistic about the company's outlook, emphasizing that its non-HKFRS financial measures provide a more accurate representation of operational performance. They also highlight their commitment to long-term investments, dismissing short-term fluctuations in fair value as inconsistent with this strategy. This suggests a focus on steady growth and stability over time. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In 2024, the company paid out $531,855 in dividends, with an interim dividend of HK 10 cents per share and a final dividend of HK 14 cents per share for 2025. Additionally, the company has repurchased shares worth RMB 353,166 in 2024 and RMB 277,634 in 2025, indicating its efforts to reduce the number of outstanding shares and potentially boost earnings per share. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary reveals potential concerns regarding inventory buildup and supply chain disruption. On page 47, a significant increase in prepayments for raw materials, $183,243, and deposits paid for property, plant, and equipment, as well as right-of-use assets, $616,374, suggests that the company may be stockpiling materials or preparing for future expansion. Furthermore, on page 56, it is noted that purchases of raw materials have increased by 44%, RMB 104,696 to RMB 150,770, and trade payables aged 91-180 days have risen by 59%, RMB 716 to RMB 288. These increases indicate a potential buildup of inventory or disruption in the supply chain. That concludes the financial summary for Cspc Pharma. Feel free to comment below, and I will be happy to answer them when possible.